In this section, we are going to talk about how to fade breakouts, or in other words, trade the fakeouts. The first thing we need to know is exactly when a potential fakeout is going to occur. Usually we can find potential fakeouts at support and resistance levels created through trend lines, chart patterns, or previous daily highs or lows. Let's start with trend lines like you can see here. When fading breakouts with trend lines, it is always important that there is a space between the trend line and the price. Like in the example here, having space between the trend line and the price allows the price to retrace back towards the trend line, perhaps even breaking it, and provide fading opportunities. Something that is super important is the speed at which the price is moving when it approaches the trend line. If price is just inching towards it slowly, a false breakout is more likely to occur, just like this example here. But if price moves really fast straight through the trend line, that could end up being a real breakout. So I would avoid fading breakouts if price moves very quickly through the trend line, just like we have here. So now the question is, how do we fade trend line breaks if we decide it's a good opportunity? Well, all you have to do is wait for price to move back inside the trend line and make your trade in the direction of the trend. So you can see there are multiple opportunities on this example here where it seems like price was breaking out and then price came back in here, and this would have been a good opportunity to enter somewhere in here with a buy, since we want to go with the trend that's obviously trending up. Or here as well, you can see it might have faked out here or possibly here as well. These are opportunities where you could have gotten in as well, where the fake out occurred, and then you could have entered a buy trade after the market moved back into this trend line. Another way to fade breakouts is through chart patterns. Two common patterns where false breakouts tend to occur are head and shoulders and double top and double bottom patterns. The head and shoulders pattern is usually difficult for new traders to spot, but don't worry if you're new, you'll begin to spot this pattern with more experience. Remember when we talked about the head and shoulders pattern being a reversal pattern? So if it formed at the top of an uptrend, it could signal a bearish reversal, or if it formed at the bottom of a downtrend, kind of like in this picture, it could signal a bullish reversal. Well, what happens is false breakouts are common with this pattern because many traders who have noticed this formation usually put their stop loss very near the neckline. When the pattern experiences a false breakout, prices will usually rebound and hit everyone's stop loss. So for example, a lot of traders will enter here after they find this inverse head and shoulders pattern that we have here, and then they'll place their stop loss here below this neckline. So what a lot of institutional traders or banks will do is they'll push the market down this way to stop a lot of traders out on their stop loss right here. So what you can do here is actually fade the breakout with a buy stop or sell stop order at the neckline. So in this example, since we're expecting the market to reverse up this way, but we're fading the breakout, so we expect there to be a fake out right here and to actually come down this way, we would want to set a sell stop order right here or kind of at the neckline so that once this does actually reverse, once there's the fake out, we can fade the breakout because we'll catch it right here. And we know the momentum is already starting to come back down this way since we know that the fake out has occurred once it's come down to this point here. So let's look at an example here. Boom, you can see that our sell stop would have been triggered here and we would have caught this move down. And all the traders that were trading the reversal on this inverse head and shoulders pattern would have entered here, and then they would have gotten stopped out about here where you would have actually been getting into a sell trade at a perfect time. Then we have the double top or double bottom pattern that's going to be the exact same. So when price breaks above or below the neckline, in this case above the neckline because we have a double bottom, it signals a possible trend reversal. So what a lot of traders do is place trades right here just past the neckline, and they're expecting the trend to reverse and start going up this way in this case. The problem is that there are so many traders placing trades there that it leaves a great opportunity for institutional traders or expert Forex traders to scrape money from the new traders. So what they do and what you can do as well to join them is fade the breakout with this pattern. Very similar to the last example that we looked at, you could set a sell stop in this example right here so that you can fade the breakout. So as this starts to fake out here and come down this way, you can catch the trend as it starts going back down this way. So what a lot of traders do is they'll enter here and put their stop loss here. But what you can do is fade the breakout, put a sell stop here, and you can see you would have caught this entire market move. For your stop loss as well, on this sell stop, you can put up here above the pattern, and that way in case it fakes you out again and starts moving back up this way, you at least will have your stop loss here and won't lose as much on that trade. So this is how you can fade the breakouts on these chart patterns. as well as you learned in this section on how to fade the breakouts on trend lines and channels.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.